Let's jump right into this week's crypto market explainer because right now we're tracking an absolutely massive structural battle playing out right in front of us. The market is actively wrestling with this incredibly stubborn $64,000 resistance line, completely mixed institutional ETF flows, and a sudden macroeconomic shockwave that is literally redefining how investors, both traditional and crypto, are building their portfolios. If you've been watching the charts this week, you know exactly how turbulent it's been. But today, we're not just staring at red and green candles. We're going under the hood to figure out what these moves actually mean for you as a retail investor navigating this space. So Bitcoin just bounced off its critical $60,000 support and is hovering near that 64K mark. But here's the massive blind spot that nobody in the mainstream financial press seems to be talking about right now. With geopolitical tensions suddenly flaring up and global oil prices spiking, we really have to ask ourselves a serious question. Are we looking at a textbook bear market bottom where the worst is finally behind us? Or, is this just a temporary fake out before one final brutal wave of capitulation? To figure that out, we have to strip away the emotion and look at the actual data. To cut through all of that noise, here is our weekly roadmap. We'll be covering macro shocks and market pulse, institutional indecision, the RWA Sector Surge, the stablecoin wars, an Onchain strategy masterclass, and finally, our community spotlight. Let's get right to it. Starting off with Section 1, Macro Shocks and Market Pulse. Kicking things off with the price action, Bitcoin experienced some incredibly heavy selling pressure earlier this week. We saw it dip sharply below that psychological $60,000 level, but then, wow, it mounted a really swift recovery to sit right around $63,300. Right now, the bulls are fighting tooth and nail against rejection at that 64,000 zone. Meanwhile, Ethereum is showing its own unique brand of resilience. It's testing its lows right alongside Bitcoin, sure, but it remains remarkably stable near $1791. And what's keeping that floor so stable? Well, it's Ethereum's underlying network utility. The sheer amount of activity happening on the chain is essentially acting like a concrete foundation against the broader market sell-off. And this whole situation brilliantly illustrates how external macro catalysts directly dictate our digital assets. Look at this timeline from Wednesday. It's like a domino effect. First, we had a sudden, unexpected spike in US-Iran geopolitical tensions. Almost immediately by Wednesday afternoon, global oil prices jumped significantly in response. Then, by the daily close, traditional investors looked at that macro fear and decided to just temporarily dump their risk-on assets and flee to safety. That cascading effect dragged the total cryptocurrency market cap down by 1.24% in a single day. It just goes to show, when the real world shakes, crypto definitely still feels the tremors. Moving right along to Section 2, Institutional Indecision. What's really fascinating here is how Wall Street is reacting to those exact macroeconomic fears we just talked about. If you were hoping the major institutions would swoop in and buy the dip to save the market, well, the data tells a very different story. Spot Bitcoin ETF flows have been entirely mixed, showing some really cautious positioning. Now, they aren't panic selling, which is a great sign for overall stability, but they aren't accumulating aggressively either. Wall Street is basically sitting on its hands, waiting on the sidelines for a definitive technical breakout before they deploy any fresh capital. So if the majors are stalling out and Wall Street is just waiting, where is the action? That brings us to Section 3, the RWA Sector Surge. Here is the crucial point for this week. While Bitcoin and Ethereum fight resistance, the real alpha is actually hiding in real-world assets, specifically tokenized stocks. Over the past 30 days alone, get this, tokenized stock transfers have astonishingly more than doubled. We are talking about a massive 105% surge, hitting $8.4 billion in transfer volume. That is enough to show us this isn't just some small speculative niche anymore. That is serious, heavy capital moving on-chain. Breaking that down even further, the distributed value of this specific sector just climbed 42% to reach $2.16 billion. And this massive growth is being driven by key platforms like Ondo, Xstocks, and Securitize. Listen, these aren't meme coins. These are platforms actively bridging traditional finance with blockchain infrastructure. Wall Street and crypto are merging right before our eyes, and as retail investors, you need to pay very close attention to the platforms building these bridges. Because while the rest of the market sleeps, this is where the undeniable exponential growth is happening. Next up on our watch list is Section 4, the stablecoin wars. The stablecoin sector is going through some massive structural shifts right now that active traders absolutely need to monitor. Following the European Union's July 1st MiCA deadline, which is their new crypto regulatory framework, the landscape has completely shifted. MiCA-compliant euro stablecoins have just rocketed up, surging an incredible 128% in market cap to reach a combined actively traded value of $674 million. Now, sure, that's still small compared to the dollar-backed giants, but this diversification is a huge structural shift for global liquidity. It proves that clear regulation can actually trigger massive institutional adoption and growth. And when we zoom out to look at those dollar-backed giants, we see this really fascinating divergence in how they're actually being used in the real world. Tether's USDT is completely dominating traditional business-to-business transfers. I mean, it recently settled a staggering $95 billion in commercial payments. On the flip side, USDC has carved out its own undisputed territory in on-chain trading and decentralized finance utility, especially across the Base and Ethereum networks. So as an investor, understanding which stablecoin fuels which specific sector really helps you track exactly where the smart money is flowing. Time for Section 5, On-Chain Strategy Masterclass. Okay, let's bypass the scary mainstream headlines for a minute and look directly at speculator behavior. We want to see if Bitcoin is repeating textbook macro bottom patterns. To truly understand the market's underlying health right now, we need to analyze a crucial on-chain metric called STH-SOPR. That stands for Short-Term Holders Spent Output Profit Ratio. I know, it sounds like complete alphabet soup, but the concept is actually pretty simple. It just tracks the coins moving on the blockchain and tells us whether recent market entrants, those short-term holders, are safely taking profits on these minor price recoveries, or if they are panic selling and capitulating at a massive loss. So what is it telling us? Right now, short-term holders are indeed taking profits on these minor bounces towards 64,000. Now, taking profits during a bounce is generally a good thing. It flushes out weak hands and builds a much stronger price floor. It's actually a characteristic behavior we see right at the start of renewed bull cycles. However, and this is the vital takeaway for you today, caution is still required. This STH-SOPR metric has not yet reached the deep, painful capitulation levels we saw during the 2022 local bottoms. This specifically warns us that if those macro geopolitical fears escalate further, we could absolutely still see one final violent flush down to reset the market entirely before a true parabolic run begins. Basically, we are not totally out of the woods yet. And finally, Section 6, Community Spotlight. This is where we break down the charts you've been asking us for. The single most requested asset this week across our Telegram and X channels was MicroStrategy, ticker symbol MSTR. Let's look at the correlation here because it's super interesting. MicroStrategy stock bounced an impressive 29% off its late June lows. Interestingly enough, the stock completely shrugged off the news that the company actually sold some of its Bitcoin holdings. But, and here's the catch that you need to be incredibly careful about, this massive rebound is running on fading volume. When the price goes up but the trading volume goes down, it means the conviction behind the move is incredibly weak. It tells us that crypto equities are acting just as cautious and indecisive as the spot market right now. So, to wrap up our weekly strategy and bring it all together, we really have to recognize that the market is currently stuck in this high-tension holding pattern. That $64,000 level for Bitcoin, that is the definitive line in the sand. As a retail investor, you need to keep a very, very close eye on those institutional ETF inflows and the macro geopolitical headlines over the next few days. Because if those geopolitical fears subside and traditional markets calm down, this technical bottom we've been sitting on is perfectly primed for a massive upside breakout. We've laid out the on-chain data and the macroeconomic factors clearly before you, but the ultimate question remains, how are you going to actively adjust your strategy today to protect your portfolio in this high-tension environment? Are you positioned for the impending breakout, or are you going to let the next scary macro headlines shake you right out of what could be a textbook bottom? Think about your personal risk tolerance, keep your eyes glued to the data, and I will see you in the next explainer.